Good evening, everyone. Good evening. I presume that all of you who are present today here have been able to deposit their cash, or maybe you have got so much of cash that you have got no other option just to forget it and leave it like that. So I'm happy that you are all here, and you must be wondering that why the speaker is Waman Kale. Hitesh Gajare sincerely apologized for not being able to attend, and it has got nothing to do with this demonetization, but he has got some official engagements which he could just not avoid. I hope I'm audible. So I think after this frenzy week that we are all witnessing, let us go back to business and this lecture meeting. I welcome you all on this meeting on transfer pricing, recent developments and controversies. According to the International Monetary Fund, India is emerging as the new global economic hotspot. The Indian economy is estimated to have grown at 7.6% in the financial year 15-16 and is expected to grow at 7 to 7.75% in financial year 16-17, making it the fastest growing major economy in the world. Therefore, it is imperative that India's cross-border and transfer pricing regime is investor-friendly and reduces potential and frivolous litigation. The journey of Indian transfer pricing regulation since its enactment in Finance Act 2001 to the implementation of the Base Erosion and Profit Shifting BEPS Action Plan 13 in the finance budget of 2016 has been a great learning curve in cross-border transaction with enough share of also. The Indian regulations have been perceived to be one of the most aggressive regimes in the world. The number of cases in dispute has been steadily increasing. It is from the frivolous litigations over the years that Finance Ministry realized the importance of reducing such litigations and the rigors of audits. To address the same, it has introduced certain far-reaching measures in the recent past to move away from a quantitative basis for selection of cases for scrutiny for transfer pricing to a risk-based system. This is expected to reduce the cases under scrutiny and thus hopefully reduce litigation. Further, the CBDT has introduced the range concept and use of multiple year data. These steps are expected to reduce unnecessary litigation and bring about a stable transfer pricing regime. The safe harbor rules, owing to its limited coverage primarily for information technology, IT-enabled services, and auto ancillary sector and R&D, and where the fixation of margins, the markups were quite high, has not attained the desired results of reducing litigation and compliance burden. The Advanced Pricing Agreement, that the APAs, provisions has proved to be a step in the right direction. What with about 580 APAs have been filed as on date, and 59 APAs have already been concluded. Further, to reduce the compliance burden for the small and medium taxpayers, the minimum limit for the applicability of the domestic transaction under the transfer pricing has been increased to rupees 20 crores. The OECD issued its final draft on BEPS Action Plan 13 in 2015, which sought to re-examine transfer pricing documentation. The intention of the BEPS report is to limit or eliminate the ability of corporations to lower their overall tax rate by engaging in transfer pricing practices that allocate profits to jurisdictions that have little or no substance. Because of this work, two key reforms have emerged from the BEPS project: the so-called master file report and the country-by-country reporting, or the CBCR templates. Both aim to provide local taxing authorities with a more global view of the MNEs operating in their jurisdiction. Many countries such as Australia, Canada, Germany, South Africa, South Korea, Spain, and United Kingdom have implemented the CBCR in their domestic law. India has implemented the BEPS Action Plan 13 in the budget 2016, which will be effective from assessment year 17-18. With this development, India has joined the global stage. In this lecture, Mr. Kale will elucidate in a comprehensive manner the whole gamut of the transfer pricing regulations in India and the recent developments in this field. Mr. Kale is an eminent chartered accountant and is a member of the Institute of Chartered Accountants of India and England and Wales. He is also a member of the Chartered Institute of Management Accountants UK. He is currently a partner with BSR and Company and has an experience of over 16 years in advising multinationals and has specialized in transfer pricing since his introduction in India. He has served clients across various industries and mainly focuses on banking and financial services. I thank Mr. Kale for readily agreeing to speak at the very last moment in the absence of Hitesh Gajaria. On behalf of all of us, I will request Narayan Pasari, our Vice President, to present a memento to Mr. Kale as a mark of appreciation and regard. Friends, please join me in welcoming Mr. Kale. Please.
Thank you very much, respected President, Vice President, fellow Chartered Accountants, ladies and gentlemen. As I begin, just maybe make mention of the fact that this week we've had number of surprises, and today you're seeing a change of speaker, so I think we're keeping that trend alive. So while I may not be able to match the erudition and scholarship of Hitesh Bhai, my senior partner, I will give it my best shot. So we will go through some of the key developments in the field of transfer pricing, touching upon some of the amendments brought about by Finance Act 2016, the key recommendations relevant for transfer pricing coming out of the BEPS project, and some recent case law which may be of interest. We'll also touch upon the Safe Harbour rules, the APA program, and then we'll have time for whatever questions that you might have. As we go along, I'll try and share to the extent possible practical experience that I've had in this field, what we are seeing currently in assessments, APAs, and share the experiences as we go along. So to begin with, we'll take you through some of the developments coming from the Finance Act 2016. The most important change which has been brought about is the result of India's commitment to adhere to the minimum standards prescribed under the BEPS project. One of the minimum standards that was identified was the introduction of a revised standard for transfer pricing documentation. So what has now come about is that the Indian documentation requirements have undergone a change to align themselves to the requirements of BEPS, which come out of BEPS Action Plan number 13. So the documentation requirements would now involve a 3-tier documentation: master file, local file, and country by country report. We will get into more details around this, but master file essentially will talk about, give a blueprint of the multinational group as a whole. The local file will be something similar to the kind of documentation that would be kept on a country by country basis, and which would be similar to what you would see in a transfer pricing report even today. The rules in relation to the master file are yet to be notified. What we are expecting is that the threshold, today the threshold for country by country reporting is $750 million of consolidated revenue. We expect that the master file may have a lower threshold. So what is the practical implication? So today when we are talking to our clients, only Indian headquartered companies, so where the ultimate parent company is in India, which has got a consolidated turnover in excess of $750 million. The translated Indian amount we will come to later, but roughly it will be around about 5,600 crores. So only large companies they would be subject to country by country reporting requirements. However, the master file requirement may kick in at a lower level. So to give you an example, there are certain countries which have already introduced their domestic legislation around master files. So Germany, for example, they have a lower threshold for master file of 100 million euros. Belgium and Netherlands have a threshold of 50 million euros. Poland has a threshold of 20 million euros. So what this means is that we need not assume that this is only something that is relevant for very large companies. It could be relevant for companies which are much more, maybe of a medium size as well. We don't know what those thresholds will be. Country by country reporting, this in some ways CBCR would a lot has been said and written about this. Now this has already been enacted. There's a new section which is introduced, section 286, where there is an obligation on the part of Indian headquartered multinational companies to furnish a country by country report along with the return of income. The applicable year, financial year for which this is applicable is 16-17. So the first reporting obligation for this will come in November 2017, 1 year from now. Why we need to start thinking of it today is because, firstly, the kind of information that needs to be collated is quite extensive. It may require even system related changes to be able to collate the information. And secondly, what is the impact of this? When this information becomes available to the tax authority, what is going to be the impact of this is something which will have an effect on our clients. So we'll come to what are the contents of this report and what kind of an impact this will have. Then there are certain very stringent penalties which have been prescribed, which we will come to. The threshold, as I said, the country by country reporting applies to very large companies. So the finance bill itself, the memorandum to the finance bill had the figure 5,395 crores. So this is basis the rate of exchange as of end of February 2016. The relevant rate as far as this year is concerned is the last day of the previous year, which would be 31st March. So based on that day's rate, it will be 5,632 crore. So any Indian headquartered multinational which has got a consolidated revenue, and when I say consolidated revenue, you would need to look at the ultimate parent company and the consolidated revenue as is appearing in the financial statements. So let me give you an example. If you are looking at, let's say the Tata Group, you would have a holding company at a Tata Sons level. You may have other holding companies, for example, the Tata Communications may have its own set of subsidiaries. What you need to look at is where does the consolidation end. If the consolidation of a particular company goes right up to Tata Sons level, then this obligation is for Tata Sons. If one of the companies like a Tata Steel or a Tata Communication, if the consolidation ends at that level, so that company in turn is not getting consolidated anywhere, then this obligation is applicable for that at that level. There are certain situations where even a non-resident, so if a foreign multinational, if they do not have exchange of information with India, there may be an obligation for the Indian subsidiary of such a multinational to file a country by country report. Other than that, if you are looking at a subsidiary, Indian subsidiary of a non-resident, a multinational headquartered outside India, then the only obligation that such an Indian subsidiary has is to notify to the prescribed authority which is the parent company which is going to be furnishing the country by country report. That's the only obligation that such a company will have. And then the Indian tax authority will obtain that information through exchange of information through the respective competent authorities. One of the important considerations is in case of a Indian multinational with a Chinese subsidiary, China has introduced these uh, master file regulations whereby their due date kicks in sometime in June 2017. So in case of a subsidiary in China, you need to be watchful that the master file will have to be in place much earlier than November 2017. Moving on to some of the penalties that are being prescribed. The first one, failure to furnish the master file. Again, this is yet to be prescribed, rules are awaited, but failure to furnish the master file by the due date will attract a penalty of 5 lakh rupees. This is a new section, section 271 AA subsection 2. Then you have 3 more penalties. Failure to furnish country by country report by the due date of filing the return of income. So up to 1 month there's a delay, there's a penalty of 5,000. Beyond 1 month, 15,000 per day. So this is coming in section 271 GB subsection 1. Then there's a penalty for failure to furnish additional information and documents which are sought by the revenue. Again, it's a per day penalty. This is coming in section 271 GB subsection 2. And finally, there is a penalty for inaccurate information filed under the country by country report. This is again rupees 5 lakhs. This is 271 GB 4. As part of the general change in the penalty provisions, in case of a transfer pricing adjustment, there is a 50% penalty in case of a under-reporting of a transaction, and in case of a misreporting of a transaction, it is 200%. Now, the important thing is that in case of a penalty, what can save the taxpayer is if proper documentation has been maintained, if the transaction has been disclosed, and all material details have been made available to the tax authority. Now, in case of a misreporting, which will attract a 200% penalty, what is important to take note of is a non-reporting of a transaction and also non-reporting of a deemed international transaction could lead to this penalty. Now, as you know, the concept of deemed international transaction has undergone a change in 2015. So we've had one cycle of reporting, but this is a second cycle of reporting, and the due date is now November 30th. So even in case you have a agreement with an Indian company, so it's a 2 Indian companies have an agreement, but if that agreement is on the basis of a prior agreement which has been entered into by the parent company, then it could still constitute a deemed international transaction, although both the parties to the transaction are Indian entities. So this was a change which happened in 2015 and we need to be cognizant of it. Certain other changes that came about in 2016. One is that the time limit for the transfer pricing assessment period was shortened, and we have actually just seen it that the cycle just got over on 31st October. Secondly, they have made some procedural changes whereby there is a minimum period of 60 days that the transfer pricing officer will get in case there is any extension as a result of a stay and so on. Any questions at this stage? We'll have time at the end, but in case you have anything. So moving on to the safe harbor rules. This is something which was introduced in 2009. The section 92CB was introduced, and it was expected that this could lead to a substantial reduction in litigation. So there was a committee which was constituted known as the Rangachari committee, which came up with reports on various sectors, for example, ITS sector, contract R&D, pharmaceutical, uh, financial transactions, and so on. And basis these, the Rangachari committee recommendations, the final safe harbor rules, they were notified in 2013. So this has been in operation for financial year 12-13 onwards. So we've just been there for 5 years. The option, when it came out, it's something that can be exercised for a period of 5 years or a lesser period starting assessment year 13-14. The objective again was to provide some certainty to taxpayers. Now the experience, this is just a list of various safe harbors which are available. The experience in safe harbors has not been very good. Perhaps it could be because if you see the kind of margins that are there. So today, for example, in software or back office, it's cost plus 20%, cost plus 22%, which are appreciably on the higher side. Now, conceptually, a safe harbor is something which will not be, it is different from arm's length. With arm's length means that you are looking at some comparable data. Safe harbor will clearly mean that there is some premium associated with it, because you are essentially availing of the safe harbor in order to buy peace. Now that being said, this creates a problem insofar as the counterparty jurisdiction is concerned. If an Indian entity, for example, is availing a safe harbor, so you have an Indian captive entity which says that I will go for a safe harbor, I will get cost plus 22%. The entity that is making that payment, they will have a problem in claiming a deduction, because their tax authority will say that, look, you are paying an entity which has availed a safe harbor, which means admittedly you are making a payment which is excess of arm's length, I will not give you a deduction. So this is one of the major drawbacks in claiming a safe harbor. Second, if you look at some of the conditions, because in order to be eligible for a safe harbor, you need to have an eligible transaction, which is what you're seeing here. You need to be an eligible SSE. So what does the eligible SSE mean? You need to be able to demonstrate that the activity that is being carried out in India by the SSE involves insignificant risk, and the conditions which are prescribed for it at times may be a little onerous to be able to demonstrate and establish that all significant activities are being carried out by the principal, and what is being carried out in India is insignificant. Practical experience, based on my knowledge, I don't think even 30 or 40 taxpayers have gone in for a safe harbor in any of the years. So the response has been extremely tepid. Few and far between. I know of taxpayers who have gone in for safe harbor and decided next year not to go for safe harbor. So experience has not been good. What is expected now is there was some discussion around reducing the safe harbor rates and making them more attractive to taxpayers. It remains to be seen what rates they come up with. If that happens, then maybe safe harbors may be looked at differently. I think we just some of the experiences we dealt with some of these things. Just touch upon a couple of other things. Once a safe harbor is availed, so let's say you go for a cost plus 20 or 22%, thereafter you cannot claim any adjustments. You can't say that I've got risk adjustment or I've got working capital adjustment. It's a blanket number, you go by that number. You cannot take a benefit of a range. You can't say that I'm within, so what, earlier we had a plus minus 3% range, today we have a interquartile range between 35th and 65th percentile. All that is not available. Taking example of transactions like guarantees and loans, the benchmarks are linked to, let's say, the SBI base rate as opposed to LIBOR. So today we have high court decisions which have stated that you need to look at the relevant foreign currency and the relevant LIBOR rate and not the Indian domestic rate. So there are some basic differences where the safe harbor may not be attractive. The possibility of economic double taxation, which as I said, the counterparty will not get a deduction, so there will be an economic double taxation. The other thing is that if you avail a safe harbor, you lose the ability to go for MAP. So because of all this, as I said, the response to safe harbor has not been very good. At best, not more than 30 or 40 taxpayers would have gone in for this in any of the years. So much so that I believe the revenue has stopped keeping statistics of how many taxpayers are availing the safe harbor. So moving on to the BEPS TP update. As I said, India is very much part of the BEPS project. So as all of you would be aware, the OECD and G20 embarked upon this project, which is base erosion and profit shifting, and they came out with 15 action plans, and India is part of this and committed to the BEPS project, committed to implementing the recommendation of the BEPS project. As far as transfer pricing is concerned, action plan 8, 9 and 10 are really the core of how transfer pricing will be looked at. Now, India's position has been that BEPS does not really represent a marked shift in terms of how they will look at transfer pricing, because India's position is that this is how we always looked at transfer pricing. If you speak to any of the officers, they will say that okay, it's really our thought processes which are today reflected in BEPS. This is something that we always get. The emphasis, if I really were to summarize in one sentence, what is the emphasis of this entire chapter 8 to 10? To ensure that the outcome, transfer pricing outcome, is in line with the value creation. So what they want to say, where is the value created, and is the reward consistent with where and by whom the value is created. That is really the crux of it. The key requirement, the first thing what they're talking about is really to identify what they call to delineate the transaction. Identify what is the transaction, what is the real deal involved. Then to look at what is the conduct of the parties, what are the real contractual obligations not reflected by the agreement, but reflected really by the actual conduct of the parties, and is it consistent with what you would expect to see in a arm's length third party dealing. This concept of, you will hear this concept when it comes to intangibles of DEMPE functions, DEMPE, which is, I find it difficult to remember, so I'll read it out: development, enhancement, maintenance, protection and exploitation. So what they have said is that entities which are performing these functions, the DEMPE functions, and who are performing and controlling these functions, that is the entity that will really be entitled to the return from the intangible. When it comes to risks, they are saying the entity which is controlling the risk, which is performing the important functions relating to control of the risk, and also which has the financial ability, financial capacity to assume the risk associated with the DEMPE functions. As far as funding is concerned, the emphasis is to stop entities which are only providing funding without any associated function from getting the return from an intangible. So for example, you have a company which is providing the capital which is required for a particular R&D development, but they don't have any people. The people are being contributed by entity B. So all the functions associated with what R&D to do, when to start, when to stop, how many resources to deploy, all those decisions are taken by someone else. So what is coming out from the BEPS recommendation is that the second entity, which is performing these activities which are controlling the risks, that is the entity which will be assigned the returns from whatever intangible activity, and the entity which is providing a mere funding, which is only providing the capital, they will only be entitled to a risk-free return on the capital that they have provided. This is so essentially they refer to cash box entities, and they don't want to allocate profits to these cash box entities. Another area which is being looked at is intra-group services. India's position has been that intra-group services are lead to base erosion. So as we have all experienced, if you have done any transfer pricing assessments, this is one area where there is a lot of challenge, where a lot of transfer pricing officers will simply disallow and say that the arm's length price of any intra-group service is nil. It's a very common adjustment that happens. So the BEPS project, as part of the action plan, they have introduced the concept of low value adding intra-group services. So which are essentially supportive activities which are not part of the core business of the group. So various kinds of support functions, as you would see. And they have said that in so far as these kind of activities are concerned, there should be a lower threshold when it comes to maintenance of documentation. What the multinational which is undertaking these activities and charging out for them, they should just be able to show that this is the way the cost is being built up, these are my allocation keys, and they should charge a markup of cost plus 5%, which should be accepted. Now this is something which is not endorsed by India. So there are perhaps the rationale would be that India has a very large proportion of services exports, and perhaps the fear was that a lot of companies may have then categorized these kind of activities to be non-core in nature and therefore put them under low value adding intra-group services. Perhaps that was one of the reasons. And secondly, that India considers these to be base, they consider this to be a form of base erosion, the intra-group services and management fees, and that could be another reason. So basically, short point is that this is one part of the BEPS action plan which India has not accepted, and this is coming out in India chapter to the UN manual, which has just very recently got publicized. So moving on to action plan 13. So as I said, there are 3 layers to the revised standards for documentation: master file, local file, and CBC report. We will deal with each of these 3. The idea is that together, all the 3 together should provide the tax authorities with a complete picture of the taxpayer of the multinational group and enable them to do a risk-based audit and focus on those areas which they perceive to be of a high risk nature. So we'll go through how this will happen. Now this is this country by country requirement. This I don't know to what extent this font is legible, but essentially there are certain parameters that the reporting entity, which would be the ultimate parent entity, they have to provide details about certain parameters like the sales to related parties, sales to unrelated parties, income tax paid both in cash for the year as well as what is accrued, stated capital, number of employees, tangible property other than cash and cash equivalents. So that is what you will see in this first table. So which is on the top right. So the columns are unrelated party revenue, related party revenue, total revenue, profit before income tax paid on cash basis, income tax accrued, stated capital, accumulated earnings, number of employees, tangible assets other than cash and cash equivalents. And what you see in the rows are the different countries. Now this information will get furnished in an aggregate form. So what a tax authority will see is that for this particular multinational group, these are the 7 countries in which, let's say, it has operations, and these are the different values. Whatever numbers that we have will get aggregated on a country wise basis, not on an entity wise basis. So let's say you have 5 entities in India. What this report will show will be aggregate picture for all the 5 entities, and likewise for any other country around the world. This is part A of the form. Then you have a part B of the form, which you are seeing on the lower section of the slide. Again, please excuse the slightly smaller font. In the handouts it will be more legible. So here again the information has to be given by tax jurisdiction, but in this case, in the second column, you will have to give the names of the entities. So for each jurisdiction, names of the entities, and then the activities that are performed. So they have listed down various activities, starting right from research and development to financing to all possible activities. And what needs to be done is you need to tick which entity is doing what activity. So the two together will give a bird's eye view to the tax authority to really see what kind of activities are being performed where and where are really the revenues. So typical issues, I can give you an example. Today, if let's say I have a significant amount of profit in, let's say, Mauritius, they will see that in table 1, they will see that Mauritius, significant amount of profit. They can see in the Mauritius second slide, second table, they can see in Mauritius what are the functions being performed. They can go back to the first slide, see number of employees. Are they seeing adequate number of employees in Mauritius? So automatically they have a red flag. So this is how this tool is going to be used, and this will be available to every tax authority where you have operations. Okay, now we come to master file. Now while this earlier country by country report gave us a granular information on various quantitative aspects, what the master file gives is a bird's eye view about the overall operations of the entire group. So there are some of these things which are prescribed. So description of important drivers of business profit, description of the supply chain, taking into account the 5 largest products or the products or services which constitute more than 5% of turnover, the main geographies, important intra-group services, functional analysis describing principal contributions to value creation. So now this information, once it is available to the tax authority, they have the ability to read this information in conjunction with what you have in the country by country report. Again, this will enable them to pick up any mismatches. So wherever you are making a claim that yes, I have some development activity going on, or I have my intangible is based in X location, do you really have the people who are controlling those risks? Do you have the people who have the ability to develop that intangible? Are they present in that location? So this kind of information will be available with the tax authority. A lot of information on intangibles, group strategy for development of intangibles, list of important intangibles, agreements relating to intangibles. So if you have differing royalty agreements to the different countries, all this will really come out. Intra-group financial activity. So also any rulings that are there, any unilateral APS that have been entered, or any other tax rulings that have been obtained in any country, those have to be disclosed. So again, Those are something that tax authorities will be in a position to obtain through exchange of information. Local file requirements essentially would take care of local country requirements for each country. So today we have Rule 10D. Similarly, every country will have its own requirements, and this will essentially be something that will be required, continue to be required for local compliance purposes. Important consideration for the local file is that is it really saying the same thing that is there in the master file? So today a lot of the documentation that is prepared is very focused or centric to the jurisdiction. So today if I'm preparing a report for India, I may look at it only from an India perspective. I may not really look at the entire value chain. So today, if the Indian TPO has the master file with him, he knows my entire value chain. So I have to be cognizant of that, and when I write my India report, it has to tie in with whatever is there in the master file and what he may have available in the country by country report. So while it may not mean there is a significant change in what we are doing today, it is just that there will have to be a better alignment with what is there in master file. Likewise, for Indian headquartered multinationals with overseas operations, there also the reports that are prepared. So today, let's say the Indian pharmaceutical company with subsidiary in the US. The US will now have better ability to really track what is being done, where are the main activities taking place. So again, there will have to be a greater focus on what is being written and contained in the local file for the US. Moving on to APAs. So APAs, that's I would say has been one of the success stories. The program was introduced in August 2012, and 2013 onwards, the first filings took place in March 2013. We've had about 4 years of APA filings, and I would say more than 505, maybe almost 600 applications have been made. So again, the basic purpose of the APA is to enter into an agreement with the government and agree upon the pricing for an international transaction for a period of 5 years. And there is also an ability to go back 4 years. So in all, you can cover 9 years. Important to note, you cannot cover specified domestic transactions in an APA. It is only limited to international transactions. There's a lot of flexibility built in. So it can determine the arm's length price or just the manner of entering into or determining the arm's length price. It is possible to have what is known as a pre-filing consultation. So today, if for example, a client has some doubts as to whether this is good for me, not good for me, what kind of people I will be dealing with, the ability to have a pre-filing discussion without any payment of fees to the government, even on a no-name basis. There are formats which are prescribed for at each stage: pre-filing, main filing, rollback. Again, the APA program, it entails a payment of a fee. So depending on the size of transaction, it's 10 lakhs, 15 lakhs or 20 lakhs for filing the APA and 5 lakh rupees for filing the rollback application. So that is a fee payable to the government. The advantage of the APA is that you get certainty around whatever transaction that you have entered into the APA for a period of 5 years. Also, as I said, there's a rollback available for 4 years. In addition to that, some of the court rulings have held that the APA methodology should have persuasive value on even open litigations. So just to give you an overview, in this example, there are years that get covered. APA is for the future, 5 years. Rollback is for the past 4 years. And there's a possibility of a renewal So as yet, none of the APIs have run their term, so we've not really seen how the renewal process takes place. But I can share with you that the annual compliance process, so the way we get the TPO undertakes a transfer pricing assessment. Similarly, in a case where an API is filed, the TPO has to undertake a compliance audit, and based on whatever we have seen in the last few months, the process is far more straightforward than what we see in a normal TP assessment. Experience with the TP authorities for APA purposes has been quite different to what you normally encounter in assessments. Um, they have been extremely cooperative, very pragmatic in their approach. Um, we have not had a single. I'm personally handling more than 15 APAs, and we are based on my based on my knowledge, I'm yet to come across a situation where someone has walked out of an APA. So largely, people are able to find some common ground and reach a solution. In certain cases where, let's say, what you're trying to ask for is something which is not acceptable to them, they will tell you right at the beginning that this is something which we cannot do. So largely, it's something which has brought mutual satisfaction. Um, Only couple of things that one needs to bear in mind before getting into APA. One is that there has to be a sharing of information. So there has to be a willingness to share information, and they will ask for a lot of information. So that's important, that there is a willingness to share. My experience, it requires a lot of commitment also from the company side. So whichever company is applying for the APA, there has to be a commitment from the business side, because there will be a lot of business related questions, so not purely tax related questions. So there has to be that commitment. There will be some requirement for them to spend some time. There is a site visit requirement where you have the APA officers. They come into the premises of the taxpayer and they will interview the officials of the taxpayer. It generally lasts for about half a day or one day, depending on the complexity. Again, it is not in any way like a raid or a survey. It is done on a mutually agreed basis, and the again experiences, there have been no negative experiences really to speak of. As far as APS can be of two types: unilateral APA, where you are entering into an APA with the Indian tax authority. You can also have a bilateral APA where where there are two tax authorities that you are dealing with. Now, bilateral APA will mean that there is no chance then of a economic double taxation, because whatever it is, you will the other competent authority has to agree to the position. The only thing is that this takes a lot of time, and so while a unilateral APA you can estimate about 1.5 to 2 years, a bilateral APA could take even upwards of 4 to 5 years. These are some key statistics. The government keeps coming out with the notifications whenever a new set of APAs are signed. I think the latest count is 104. 104 unilateral APAs and 4 bilateral APAs. A total 108 APAs have been signed. I believe there is a signing happening in a few days from now, so this number is going to change very soon. So any questions at this stage? Sure. Yes. There is no dispensation from that compliance. That's independent. I would say I'll go one step further. Even if you get an APA, there is no dispensation from obtaining a Form 3 CB. There is no dispensation on that. So, see, there's nothing in the law which dispenses the taxpayer from getting a Form 3 CB. There certainly not, but I'm saying even one step further, even there's Form 3 CB is required. See, the main advantage of the API is the certainty that it is giving you, and the litigation or the other year-on-year assessments that it is saving you from. That's the main.
If we agreed on that, yes, secretary and officers, revenue is both agreed on the mutual agreed procedure. And after that, if suppose by country reporting, they come to know about maybe something which is need to be taken further, or maybe something which is looks to be suspicious that you wanted to do some sort of.
Okay. So I think your question is really that based on information that then subsequently becomes available with them based on country by country, can they proceed to cancel the APA? See, any APA will always have a condition that if you have misrepresented facts, then it is liable to cancellation. So it depends on, so we would always assume that all material facts are disclosed and the authority would also, examine them in detail. So, but if there is a, some suppression or misrepresentation, then yes, that risk does exist.
May not be happen from the side, but if the officers feel or maybe revenue authority feel that here this information would make it different in the decision of an APA. So again, you cannot stop that.
See, we'll have to see when it comes, but regardless of country by country, that risk always is there.
So far experience, have you come across whether they are taking rates below the safe harbor rules? Are they agreeing for in the APA?
See, if they offer a safe harbor rate, why would I enter APA?
So, whether there is a drastic.
In fact, every APA will be less than a safe harbor.
Correct.
I would be surprised if there is a single APA which is above a safe harbor
then
rate.
it's no point in going.
Then you won't go for it.
Time of filing the CB, whether you need to intimate that you are into APA or because there is no column in the form itself.
Nothing.
So how do you mean it's not required then? Because the rollback, how does it happen?
See, what will happen is it's a good point. In the Form 3CB, I will make a mention. Now, online I don't have the ability to give notes, but I will, when I file something, I may say that I have entered into an APA. But there is no requirement for me to do it. Because I have to, in the documentation that I maintain, while I may not have to do any search. For example, today if we are let's look at a cost plus kind of an entity. Whatever the number is, you have to justify that basis certain comparable data, or for any other method you'll have to justify on the basis of certain comparable data. In this case, I don't have comparable data, but I have an APA. So my documentation will refer to the APA. Yes, sir. Yes. 104.
Yeah, 104.
Plus 4.
Yeah, I think 90 to 95% are unilateral. Only 8 or 10 is probably.
4 bilateral, 104 unilateral.
Correct. So now.
Government statistics.
Yeah, so why bilateral is not, it means the other government not agreeing to our aggressive margins, and that's why it is not concluding, or what is the reason? Because India wants 18% for say ITES services. The other government may not be agreeing.
So,
and lastly, any statistical public database is available. What are the rates approved in APA in unilateral? If you can share that.
Sure. So on the third point, to the best of my knowledge, there is nothing shared in terms of the rates. So whatever it is, it's through word of mouth that people would come to know. And again, that is also in keeping with the fact that these are all private arrangements between taxpayers and the government. So I don't think they would be in a position to publish. What they are allowed to publish is only which, if let's say on a particular sector or a particular, a particular method or approach that is used, that is something that they are allowed to publish, not the rate. Coming to your other question, the reason for bilateral APA is taking more time. I think one of the points is that the two competent authorities, there has to be, they have to meet, and a lot of competent authorities. So if you look at US, UK, Japan, these meet with India fairly regularly. But there could be certain authorities which they just don't meet in a year. Those authorities do not have adequate amount of staff. So all these considerations come into play. It is not just the whatever inflexibility, if you will, that India may show on markups. Because if you look at some of the MAP settlements that have taken place, so you would have probably read that India and US, they entered into a MOU, and a large number of cases got settled under MAP, and depending on which assessment year they were pertaining to, markups ranging from about 14 to 18%. This was the range depending on the assessment year. A number of cases have got settled. I think the bilateral APA, the number you will see that the number will increase, and the timeline, I don't think it is materially different. I was talking to one of my colleagues from Germany, and he shared with me that so he had just concluded an APA and they were in the 5th year. So he says, it's the first time I've signed an APA before the term of the APA is concluded. So a bilateral APA, and it was bilateral. So bilateral APAs do take that kind of a time. So I was working on, when I was in New York, I was working on a bilateral APA where the term of the APA had closed and we had not yet signed the APA. So it does take time. So moving on to, it is kind of related to what we were discussing on the APA. If just to talk about the issues and challenges involved in a FAR. So FAR stands, as you all would be aware, functions, assets, risks. So in a sense, this is really the, I would say, the bedrock of transfer pricing, because ultimately whatever comparable data that you look at, everything depends on the assessment of functions, assets, risks. First issue that comes up is, what is the level of detail? How much information do I give? And many times, and the common refrain of the tax officials is that what we get is useless. What we get from the taxpayers is useless for us. And this is a very common refrain that comes, and I think partially to an extent it's important for us to also reflect upon it, that are we really giving information which is useful or appropriate for the tax officer to look at. So there obviously has to be a balance between how much detail and how much less, more, but I think it's important that we give an accurate, correct description and make it available to the tax authority. Increasingly, the emphasis is going to be more in terms of what is the actual conduct of the party rather than what is the letter of the contract. This is, if you look at BEPS, if you look at all the developments that are coming out. So let's take the example of, let's say an Indian company sets up a distributor somewhere, let's say in UAE. I have a distributor in UAE. And I say that the distributor is, he's managing my entire sales in the Gulf and Africa region. He's a full-fledged distributor. He's taking on inventory risk, taking on debt receivables risk. But key things are, does that distributor have the necessary personnel? Do they have the necessary persons to take decisions? So today, if I talk about receivables risk, who is taking the decision as to whether or not to lend to a particular buyer? If all the decisions are being taken from India, then really are they managing the receivables risk? If they are not managing the receivables risk, then should they be compensated for taking on that risk? Likewise, inventory. So the functional analysis may say something, but if it is not reflected by the actual conduct, then this distributor, whom I may assign as a value-added distributor, assign him a lot of profits, he may turn out to be like an agent. Financial capacity to undertake risk. The distributor, if there is a bad debt, is he capitalized enough to be able to absorb that risk? If he's not capitalized, then he doesn't have the ability to take on that risk. I cannot assign that return to him. So BEPS Action Plan 8 to 10 is now, this is something which India has stated in the UN, in India chapter to the UN manual, that they have accepted the recommendations coming from that report, and that is how they would be implementing. In fact, they have stated that the examples that have been given in the BEPS Action Plan 8 to 10 reports, those should be taken into account when interpreting various situations. So I'll take you through some very recent decisions. I'm conscious of time. We have about 15 minutes. No. So the first issue that we deal with is on marketing intangibles. Now, this is probably has been one of the most talked about controversies in the last few years. It first started in 2010 when we had the Maruti Suzuki Delhi High Court decision where Maruti Suzuki filed a writ petition. Since then, we've heard a lot about this. The issue the very simple issue involved is whenever an Indian company undertakes certain expenditure for advertisement, marketing, or promotional activities in a situation where the owner of the brand or the trademark is a non-resident, then does the Indian entity deserve to be compensated for whatever expenditure it is incurring? This is really the crux of the issue. Now, if I really look at it purely from a tax perspective, you may say that where is the international transaction here? Because whatever I'm spending or whatever this so-called advertisement, marketing, promotion, what is it? Ultimately, it is something that I've paid to local media, something I've paid to local advertising companies, and so on. I have not paid a single naya paisa to someone outside India. Where is the international transaction? So the case of the revenue is that this is giving a indirect or rather direct or indirect benefit to the non-resident because it is making their brand, owner of the brand is the non-resident, it is making their brand well known in India. The revenue's position is what is the benefit to them? One is increase in sales. Second is an increase in their value in India, which eventually may give them a higher exit value. These are the two benefits that the non-resident is supposedly getting. Now, important for us to understand that when we talk about the benefit to a non-resident, what is really the benefit? And it will differ from entity to entity. Let me give you the example. Take the example which a lot of us can relate to, automobile industry. Take any of the car manufacturers, take a Ford or a Fiat, General Motors. They would have spent a lot of money in advertisement and promotional activities in India. But what are they meant for? They are meant for selling in the Indian market. Today, when Pepsi comes up with an ad, at one time it was "Yahi hai right choice, baby." That was meant for the Indian market. How does it help Pepsi outside India? So it is driving sales, but yes, it is driving sales of that company in India. So unless there is some benefit which the non-resident is earning. So today, for example, the Indian company doesn't have its own sales. The Indian company, let's say, is just an agent. And then it is incurring some disproportionately high expenditure and the sales are all direct sales by the non-resident, then yes, you may say that there could be some benefit. But not in a case where the Indian company itself is the entrepreneur and making the sales. Anyway, what is it that the revenue is doing? The revenue has borrowed certain concepts, and I would say borrowed certain concepts selectively from certain international case laws and introduced the concept of a bright line test. What does this bright line test mean? They do a comparison of the advertisement, marketing, promotional expenditure of any SSE. Let's assume that this particular SSE has an expenditure of 8%. They will look at certain comparables, look at what is the similar advertisement, marketing, promotional expenditure incurred by those comparables. Let's assume it is 4%. So they will say that 4% of sales represents a bright line. Anything above that bright line is excessive marketing and promotional expenditure, which means that you are doing something beyond what you were supposed to do, and therefore your parent company, owner of the trademark, owner of the brand, they should compensate you for it. So they are saying they should compensate you for those costs. plus pay you a markup. So this is really in a nutshell what this entire controversy is about. Now, matter has traveled to the courts. Number of companies have faced this adjustment. They continue to face this adjustment. There are three rulings which are very important on this subject. So as I said, 2010 Maruti Suzuki Delhi High Court, that was the first decision that came out. That was in the context of a writ petition. That decision was later stayed by the Supreme Court. That decision does not have application today. Thereafter, 2013, there was a special bench which was constituted for this issue in the case of LG. And then there have been two Delhi High Court decisions which are more recent, Sony Ericsson and Maruti Suzuki. Now the first issue is whether this AMP expense, again AMP is a domestic expenditure incurred by the assessee, payments to advertisers, media companies and so on, whether this AMP expense constitutes an international transaction. LG special bench had held that yes, it does constitute an international transaction. More recently, Maruti Suzuki has held that it is not an international transaction. So again, the whole issue is there are fact specific nuances which I need not go into right now. But the issue, and today the position that India has accepted based on its UN chapter, India chapter, they have said that merely because I have incurred incurred expenditure higher than a certain level, higher than whatever is termed to be bright line, that itself does not mean that I have an international transaction. So you cannot infer an international transaction merely because I have incurred excessive advertisement expenditure. You have to be able to show some nexus between incurring that expenditure and some agreement that I have with my parent company, owner of the trademark, compelling me to incur that expenditure. That kind of an agreement has to be shown, then it can be a international transaction. Of course, this matter has gone to Supreme Court, so we will hear something more on this issue. Next issue is whether application of this bright line test and bifurcation of revenue into what is normal or routine and what is non-routine, whether that is appropriate. Again, LG special bench had held that it is all right to undertake this kind of a bifurcation. Sony Ericsson Delhi High Court has negated this. They said that you cannot have something as arbitrary as drawing a line somewhere and saying anything above that is non-routine. Similar approach is followed by Maruti Suzuki. They have, so as things stand today, the Delhi High Court has rejected this whole concept of a bright line. Now that being said, what is happening in the assessments? Our experience this year, while not calling it bright line, through the back door similar kind of things are still being done. They just don't call it bright line anymore. Some of the other issues that have come up is whether this transaction of AMP should be treated as a separate transaction or should it be looked at in totality, because this transaction is not you don't incur advertisement expenses for the sake of it. You are incurring it for your business. So I should look at what is the result of the business, what is the profit I have earned from that business. So can I combine the transactions or do I need to look at this as a separate transaction? So there again LG has been overruled by the High Court. High Court has taken a view that you can look at the overall activity, and for example if the overall profitability is higher, then that means that the AMP transaction, even if it is admitted to be an international transaction, that is at arm's length. Again, similar principle about whether I can aggregate and set off the transaction. Finally, on economic ownership of intangibles, the LG special bench had held that there is no concept of economic ownership. that has again been overruled, and the High Court has recognized that there is such a thing as an economic ownership. So I think what is important in these situations is for the taxpayer to establish what is its FAR, what is the functional analysis, whether the activity is leading to benefits that are being derived by the taxpayer, or are the benefits inuring to the owner of the brand. I think that is very important to be established. Based on those facts, then a determination can be made as to whether such an international transaction even exists. Matter, as I said, has traveled to the High Court. These are certain questions that have been framed my apologies. Matter has traveled to the Supreme Court. These are the 8 questions that have been framed. Based on what is reported, the hearing is scheduled on 22nd November. That's so hopefully there will be some finality to this issue. Quick update on what India is saying in the India chapter on the UN manual. So I think most of this we have already covered. That existence of an international transaction needs to be first established. It cannot be assumed that merely because I have incurred excessive advertisement and promotional expenditure that an international transaction exists. Compensation need not be a separate compensation for it. It could be in the form of, let's say, lower import price. It could be in the form of reduced royalty. It could take any form. Finally, they have made an important comment that where it is clear that the promotional activity is performed with the intention that the taxpayer himself should derive the benefit, then this issue ought not to arise. So it remains to be seen ultimately how the Supreme Court deals with this issue, and whether there is additional guidance on this controversy. My own personal view is that this is something which is essentially a fact specific. It will have to be looked at case by case. While bright line as a concept is completely incorrect, but there will be cases where when expenditure is incurred in India, while it may not be an international transaction in the traditional sense, it will still require some compensation for whatever activity is being carried out. Moving on to corporate guarantees. We are all aware of what is a corporate guarantee, and we have seen press reports recently of where it has been speculated that if Tata Sons rescinds its corporate guarantee, what the impact would be on various of the large operating companies also. Now, this has been a subject of a lot of litigation both in India and overseas. GE is one of the case laws which has been very important case law on this subject, Canadian case law, but there's a lot of litigation in India as well. The taxpayer's approach is that this is really an activity which is in the nature of a shareholder activity, and therefore there ought not to be any remuneration assigned to the grant of a corporate guarantee. And especially now there's a difference between a corporate guarantee and a comfort letter. The comfort letter may not even be legally enforceable. So that's a separate controversy, whether a comfort letter also can be equated with a corporate guarantee. The department's approach has been that you need to look at what is the benefit, because clearly as a result of a corporate guarantee, the subsidiary company does benefit in terms of lower interest rate, and they believe that the parent needs to be rewarded for that benefit. At a ground level, adjustments have been made looking at guarantee figures that have been published by public sector banks offering bank guarantees at 2 and 3%. So that's kind of what happens, or in the past has happened at a ground level. There are a couple of decisions on this issue. So if I really go back, there was a decision called Forsoft, Hyderabad Tribunal decision, which came prior to amendment by Finance Act 2012, which held that corporate guarantee is not an international transaction. post amendment, so essentially Finance Act 2012 that introduced the definition of capital financing into international transaction under 92B explanation. There were two decisions, one Bharti Airtel and second Micro Inks. Both these decisions held that even after amendment, even after 92B amendment by Finance Act 2012, corporate guarantee is still not an international transaction because there is no impact on the profit, income, losses or assets until and unless the guarantee is invoked. And in that case, the decision has said that it cannot be a contingent impact. It has to be an actual impact, and therefore they have held that it is not a not a international transaction even after amendment. Now that view may not really be followed by a lot of taxpayers, maybe a extreme view. Now this case which we are talking about, sorry, one more thing which Micro Inks also has dealt with is they've held that this is not a international transaction, not even a service. So the other thing is that, okay, while it may not be capital financing, not a guarantee, but I have still provided him with a service. So there they have dealt with this issue and said that because this is really in the nature of a shareholder activity, therefore it is not a service. So again, not an international transaction. So this is a case which is a more recent case, Kolkata Tribunal. So again, there was a corporate guarantee which was provided by an Indian company to ICICI Bank in this case for extending a loan to a foreign subsidiary company which was a SPV, which was set up to acquire certain operating subsidiaries. So this was held as a shareholder service, really going on three aspects. One is that looking at the debt equity ratio of the SPV, no one would have lent any money by way of debt. Second, the expectation in going into this transaction, the expectation was not to earn an interest or not to earn a guarantee commission. It was really the company, Indian assessee, acting in its capacity as a shareholder to protect its investment. And they considered this as a quasi-equity. The loan was considered as a quasi-equity and the guarantee was considered as a shareholder activity, and this is a favorable decision that the assessee in this case has got. Moving on to another decision which again recently it's a special bench decision in the case of Instrumentarian Corporation. This deals with an important issue which typically comes up very often in our assessments. There's a concept of base erosion. So in this case, I'll quickly go through the facts. In this case, the taxpayer, it's a Finnish company, non-resident, engaged in certain business activities, and it has granted an interest-free loan to its Indian subsidiary. Now the assessing officer has said that the non-resident should have charged interest. They should have charged interest, and it has imputed interest in the hands of the non-resident. Now the argument of the taxpayer is that this would lead to a base erosion because insofar as the interest is concerned, India, let's say, gets 10% tax, but correspondingly, if they were to charge that interest, the paying entity would get a deduction of 30%. So to that extent, there is a base erosion that would result if this were to happen. Now, the way the tribunal has dealt with this, they have interpreted the law by the letter and said that each of the two assessments would have to be looked at separately, and the section 92.3 says that transfer pricing provisions would not apply if it would result in a reduction in the taxable income. They said that would not happen in this case because we are attributing this in the hands of the non-resident. If you make a adjustment, it will be taxable in the hands of the non-resident, and there is no mechanism by which the Indian associated enterprise can get a deduction for the amount that is added. There is no mechanism for that. So he said we cannot interpret law according to how it should have been written. We have to interpret the way it is, and that's how we are left with this decision. Now, practical challenges. There will be a lot of cases, not only interest. There will be a lot of cases involving number of activities which are not charged by the non-resident, and we could have situations where officers could go after those non-residents and raise notices. So this is something that we need to be cognizant of. And while we are reporting for the non-residents, in cases where there are these kind of transactions, there has to be some adequate documentation to be able to show that there is a commercial rationale for it, or that there are certain, it's in the nature of a shareholder activity. Coming to the instrumentarian corporation case law, here perhaps the tribunal was influenced by certain facts associated with the case. For example, there it comes out of the decision that the taxpayer had not cooperated. It also comes out that the taxpayer was incurring losses. So they said, okay, even if you take that argument, that would not have, your base erosion would not have, argument will not hold good because the taxpayer has losses. He would not have been able to claim that as a deduction today. And even if you say he could have claimed it after, in a future year, there is still a time value of money. So those kind of arguments also come in this decision. One doesn't know to what extent these facts have influenced the ultimate outcome, but the way the decision comes out, it is not limited to the facts of this case. It would have a general application. So till such time that the matter has gone to the High Court, till such time that we have a High Court ruling, this is something that we need to be conscious of. And there will be situations where non-residents will face problems as a result of this. So I think with this, pretty much come to the end of my presentation. Please.
This last case law, that is a Kolkata special bench case law. My question is that in this case, a non-resident was filing a return of income in India. In case non-resident is not filing return of income and forms received in India, and they have not charged interest or remuneration for the guarantee, in that case, for the Indian taxpayer, is it necessary to make adjustment on a conservative basis, considering the BEPS approach, or as such, from tax perspective of India, it is good for the Indian tax authorities that nothing is going out of India. So should we do anything, so any adjustment, or we just keep it like that way?
So to answer your question, first of all, so you're assuming a situation where, let's say, Indian taxpayer has received a interest-free loan.
Correct.
Or let's say there is a guarantee from which I am benefiting. Right. Now, there is nothing that you can really do, right, because you can't do anything. Now the non-resident, I think we'll just have to be clear as to the commercial rationale for this and have documentation to that effect. But there is nothing that you can do. Ultimately, this matter will travel to the courts. We'll have to see how the courts will look at this whole base erosion argument.
Payment of dividend by subsidiary to holding company. So whether it amounts to international transaction.
So in this case, your holding company is India?
Yes, holding is a foreign entity.
No, so what are you saying? Indian company
Indian
paying
company
a dividend?
paid dividend to foreign entity, or vice versa, both.
No, so two are different.
Okay.
The Indian company paying a dividend to a non-resident, that's an appropriation of profits of the Indian entity. I would take a view that this is not an international transaction.
Okay.
From a penalty protection perspective, you may want to make a disclosure because, my personal view is that this is not an international transaction. This is an appropriation of the profits.
Okay.
You can't compel me to pay, more dividend.
And vice versa?
Vice versa, again, I would take a similar view, but there is no benchmarking involved. But in the reverse case, it is an international transaction.
Okay. Second
Because
is
second, I would say, is an international transaction, but it is income for the Indian entity. But there is no benchmarking involved because it's dividend in nature.
Next query is about cash assistance, cash assistance received by Indian entity or subsidiary or foreign entity, both ways, from holding company to run the business
Hmm.
for incurring day-to-day expenses and all. So whether
So-
it will be
So like a first let's look at inbound
yes.
cash assistance received. So
Mhm.
will it be like a subvention payment? If it's a subvention, then you are going to offer it to tax.
Mhm.
So then what's your question?
Nay, the holding companies,
No, no, you're receiving money
yes,
as a subvention.
yes.
So you will offer it to tax.
So we have to
No, are you
offer
receiving it as what? If are you receiving it as share capital, or are you receiving it as a subvention?
as a subvention.
If it's a subvention, you would offer it to tax.
Okay. And not as a capital receipt. Can we treat as a capital receipt? There is a Delhi High Court decision in this regard.
See, again, it will depend on the facts and circumstances, but typically, my experience is that you will do this when, let's say, you have a challenge on your, let's say, margins. This will not be purely for financing. There may be a challenge on your margins. Then it will be necessary for you to be able to show that this is in the nature of a subvention, because then you will be able to show this as an operating income.
Okay.
It depends on what the objective is.
And last query is till now I think the C by C reporting is not notified or as per income tax rules and so. So when it is to be expected, or
No,
do we have to prepare the documentation from now, because from assessment year 17-18 it will be applicable, and whether any guidance note in this respect specifically?
No, so there is a circular which is awaited. So
Okay.
till now what you have section 286 which has been enacted.
Correct.
You have the memorandum to the finance bill which largely lays out whatever is there in action plan 13.
Mm-hmm.
What we are still awaiting is the rules associated with this, which we still don't know when they'll come. But the advice would be to start preparing for this along the lines of whatever is there in action plan 13. Because yes, you're right that financial year 16-17 you'll need to keep this data ready and to be filed in November 17.
And suppose the associated enterprises or holding entity, foreign entities of Indian entity are having calendar year or some other financial year, other period as financial year, accounting year. So we have to take financial year in that respect to calculate the turnover for 15-16, I think, financial year 15-16, April to March. So then they have to prepare accordingly and provide, or what stand to be taken in that? Because their accounting period is different.
No, so your question is about a non-resident entity which will be the ultimate parent, whether they are liable for country by country reporting or not. So let's assume that their turnover is higher than 750 million.
Okay.
So they will prepare it according to what is their, whatever, if they are following calendar year, they will prepare it by calendar year. So this rule kicks in with effect from financial years beginning on or after 1st January 2016. Okay. So calendar year 2016 is the first calendar year for which this is applicable. So let's say in your case, let's say you're an Indian subsidiary of this multinational. So you will have to notify to the Indian tax authority, or rather the prescribed authority as they have stated in 286, by the due date, which is November 2017, as to who is the reporting entity for you. So as a constituent entity, you will be a constituent entity. You need to report who is the reporting entity and what is the country of their residence. Now they will prepare the country by country report in the manner looking at their own fiscal year. Now if your question is what is the data that you will have to give them, So there is some flexibility because for any case for your consolidation purposes, you will be providing them with the data, which is what they will consider.
Okay. Thanks a lot, sir.
Yeah, please, you can sit down here. Just one question, whether there can be a issue of any double taxation in case of country by country reporting, because each country will may not accept what you have stated there. So what are the chances there?
So in country by country reporting, so two things. One is that they have said that the data that is submitted in the country by country report, that itself should not be used for purposes of making assessments. So it is only an indicator, only the starting point for them to do their risk-based assessments. So that the data that itself should not be used as something like what they call a formulatory approach. They should not use that as a proxy to make adjustments.
Let's hope they do it.
That's absolutely.
So any other query or? So I will just request Narayan to make few certain announcements and propose a well-deserved vote of thanks to Mr. Kale. Thank you.
Thank you, Chetan. First, an announcement. State Bank of India and its affiliate banks have received 53,000 crores as deposits till 2.5 days, that is till midday today, as per their chairperson. BCAS has announced a number of programs, a few of them which I will inform you. Next Friday at this very hall, we'll have an expert chat at BCAS, issues and impact of demonetization. Ms. Sucheta Dalal will be in talk with CA Amit Patel. There is a full day seminar on alternate fundraising options for corporates jointly with the Chamber of Tax Consultants on Friday 25th November at Walchand Hirajan Hall. It includes a lot of galaxy of speakers, including Nimesh Shah of ICICI Prudential, Bhavesh Shah of JM Financial, Amit Tripathi of Reliance Mutual Fund, and many others. There is a two-day advanced Excel seminar on 25th and 26th of November in this very hall, and a two-day orientation program for CA students on 8th and 9th of December. Coming to the vote of thanks, the definition of a substitute is to use something or someone instead of another thing or person. The definition for substitute for is to perform the same job as another thing or take its place. In consumer theory, substitute goods or substitute are products that a consumer perceives as similar or comparable, so that having more of one product makes them desire less of the other. So it is in services, and so it was today in case of Waman Kale, our learner speaker. Mr. Kale went through the presentation on recent transfer pricing developments and controversies. He spoke about minimum standards for BEPS projects, 3-tier documentation, master file, local file, country by country reporting, deemed international taxation, safe harbor rules, BEPS action plans 8, 9, 10, 13, DEMPE functions, APAs in India, issues and challenges in FAR, AMP expenses, and a concept of parietal line. He also answered the queries raised by the audience. Our understanding of the subject must have surely improved by his talk. I, on behalf of BCAS, immensely thank Mr. Kale for readily agreeing to take over from Mr. Hitesh Gajaria and request all present to carry this vote of thanks with a loud cheer. Thank you. More than